Easily one of the most common questions I get on this channel from people is, aren't higher yielding investments riskier on average? And my answer to that question is always the same, which is no. Just because a stock or an ETF is offering an above average yield does not mean it's by nature a riskier investment. Now when I say higher than average, I'm referring to what the average yield is in the overall market. According to YCharts, the average yield of a dividend stock in the S&P 500 was 1.74% as of last December. Or if you look at the typical higher yielding dividend ETF like ticker symbol VYM, it currently offers a yield of 3.01%. But my response is sometimes met with skepticism. Most financial advisors that you speak to will tell you to avoid the higher yielding positions. Plus, there's many people out there who pursue dividend investing, and at the beginning they followed this exact format. They learned what dividend investing is, and they love the idea of being able to receive passive income from their investments on a quarterly or a monthly basis. Then they open a brokerage account and they start looking at different stocks and ETFs that pay shareholders dividends. Maybe you go to Yahoo Finance or Seeking Alpha or some other website and you use their tool to find dividend stocks. But then guess what a lot of people do? They start filtering stocks by the ones that offer the highest dividend yields. And then they start thinking to themselves, if I put my money into stocks offering 15% yields, then I'll be able to live off dividends at a much quicker rate. And so they put their money into the Arbor Realties, the Orchid Island Capitals, the AG&Cs, and so forth. Then after holding these stocks for a few months or maybe a year or two and seeing their share prices fall dramatically or even going through a dividend cut or two, they'll realize they made a mistake in pursuing higher yielding investments. Then they sell their positions at a loss and sometimes give up on investing for dividends and living off this form of passive income altogether. Often people who are interested in pursuing dividend investing are told not to chase yields, which simply refers to not investing in anything above a specific yield percentage in their heads that's different for everyone. The reality is though that there is no magic yield that you can rely on. It doesn't make sense to tell me that as long as I don't invest in something that's above a certain dividend yield that I'm magically going to be safer and more likely to not go through a dividend cut. The truth is a lot of consumer staple stocks, the so-called lower yielding dividend holdings that provide years of growth, can and do experience dividend cuts. Most notably within the last couple months was Intel. Touted by dividend growth investors as being a safer investment, Intel stock successfully went 23 years without a reduction in their dividend. The last time the company cut their dividend was all the way back in August of 2000, where they reduced it by just 1 penny. But then in February, the company announced that they were going to reduce their dividend by 65%, going from 36.5 cents per share to now 12.5 cents per share. For years, Intel stock had kept growing, which won the hearts of many dividend growth investors. But then just like any other company, regardless of its dividend yield, they became susceptible to difficult times. Another big example in recent years was the story of General Electric. At the time, GE had successfully paid dividends to shareholders for 119 years when the company went through trouble. After taking on too much debt, the company announced that they were slashing their dividend to just 1 penny. GE was and continues to be a household name. They're one of the most well-known consumer appliance companies in America, and they operate in a whole bunch of different sectors, including aviation, wind turbines, software, and medical imaging. The stock of one of the largest companies in America that offered a lower yield than the so-called high-risk stocks wasn't able to escape a dividend cut. Then of course there was Boeing, who stopped paying a dividend in 2020, which broke a long history of distribution growth since the 1980s. So why am I pointing all this out? It's not because I hate lower yielding dividend stocks, but suggesting that a lower yielding stock is automatically a safer investment is not an accurate statement. It doesn't matter the yield that a stock is offering, it can ultimately face a dividend cut. And what some people fail to realize is that some stocks by nature offer higher yields because they have to. For example, nearly all real estate investment trusts offer higher yields than average. It's because they're required by law to pay out 90% of their earnings to shareholders. The average yield for a REIT is approximately 3.49% as of March, which is quite a bit higher than the average, and some can yield even much more than that. So are real estate investment trusts riskier than the average dividend stock? The truth is, just like any dividend stock in the S&P 500, you've got some REITs that are good, some are mediocre, and some that are bad. There's many REITs out there that offer higher yields than average and have gone decades without getting a dividend cut. Essex Property Trust, Federal Realty Trust, Realty Income, National Retail Properties, WP Carey, and Universal Health Realty are just some REITs that have gone decades without a cut. There's plenty more out there that have great long-term track records. Then you've also got business development companies. These are another investment that have similar requirements to REITs in that BDCs are required to pay out 90% of their earnings to shareholders in the form of dividends. Unlike REITs, BDCs have much higher yields on average, usually around 8 to 10%. If the theory of higher yields means higher risk, then certainly a lot of these companies have been going through dividend cuts, right? We're in the middle of a bear market, interest rates are soaring, employees are getting laid off, and share prices are still down. If the theory that higher yields are dangerous, then this sector should be seeing dividend cuts like crazy. But as someone who's currently invested in 9 BDCs, not a single one of them has seen a dividend reduction. In fact, a lot of BDCs have actually been increasing their dividend distributions over the last year. Because these corporations invest in floating rate debt, they've been seeing their income soar in our high interest rate environment. So up to this point, this high yield sector has not been seeing their dividends get reduced. The share prices are down like everything else, but the income's kept coming in and growing. Now, obviously, if things do get terribly worse in the economy and we do experience another 2008, which according to most economists is very unlikely, then there could be cuts. I'm sure that most people who think I'm wrong are going to insist that the dividend cuts aren't here yet. But if there's one point I want to make when it comes to a stock's dividend yield, it's this. If you invest in the higher yielding stuff like REITs, BDCs, closed-end funds, and so forth, if you invest in the things that are yielding around average for that kind of holding, then you're generally going to be much safer. Since REITs yield around 3 to 4% on average, if you invest in equity REITs that offer yields around 3 to 4%, then you're usually going to be just fine. BDCs yield around 8 to 10%, so if you invest in BDCs yielding around that range, then you're typically going to be much safer. Obviously, it's not risk-free, but you can greatly reduce the amount of risk that you're exposed to. There's opportunities out there that offer higher yields, like I hold some BDCs that offer yields close to 12%, but they're still around that general range for that kind of company. When you come across a stock with an outrageous yield, that's when you should recognize that it's an extremely risky holding and more likely to suffer a dividend cut. For example, and I think this is the third video in a row that I brought this company name up, but Trinity Capital is a BDC that's offering an outrageous yield right now of over 16%. I just performed my own due diligence on this stock and I came to the conclusion that it's a very, very risky holding and I can potentially see issues in their future. If you learn how to spot a sucker yield like the Orchid Islands and the Armor Residentials, then like I said, you're usually not going to experience major dividend cuts from all of your favorite higher yielding stocks. The overwhelming majority of the time people that get sucker punch dividend cuts is when they reach for the highest yields they can possibly find. It's important to learn what to look for in an equity or a mortgage REIT or a BDC or a closed-end fund and so forth. Once you do, then you can pursue the higher yielding investments with less risk. If you've been following my channel for a while, you'll know that there's holdings that I have that are yielding much higher than average for that kind of stock. But I don't go crazy and start investing a ton of money in highly speculative investments. When I do make investments in companies like Sachem Capital, Medical Properties Trust, and the PIMCO Dynamic Income Fund, I do my research and I decide that investing a reasonable amount into these holdings is a fair risk worth taking. And if any of them were to suffer a dividend cut, even a fairly major one, it wouldn't be a financial wreck for me. So remember, a lower yield does not mean lower risk. Some investments have to offer higher yields because they're legally required to. And as long as you pursue higher yields that are within a reasonable range for that kind of company, you can greatly reduce the amount of risk that you're exposing yourself to. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to click that thumbs up button and also click subscribe if you want to see more higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.